Forget everything you think you know about how markets are supposed to work. Ignore the instinct that tells you this is just a temporary error, a blip, a strange holiday anomaly that will correct itself when the grown-ups get back to their desks. What is appearing on financial screens right now, in the quietest hours of the trading year, is not a fluctuation. It is an autopsy. It's the first conclusive evidence that a core system governing global trade and capital has suffered a catastrophic failure, and we are witnessing its vital signs flicker in real time. The number is $80.50. That is the price, verified by the official settlement data of the Shanghai Futures Exchange, converted and calculated to the penny for 1 troy ounce of physical silver, available for immediate delivery in the world's largest manufacturing economy. Now, look at your screen. Look at the ticker for silver on the COMEX, the London bullion market, your brokerage app. It reads $71.80. The space between those two numbers, $8.70, is not a spread, it's a verdict. It is the market's brutal mathematical declaration that the principle of arbitrage, the unshakable law that has bound global commodity prices together for the modern financial era, is dead. This law states that if the same good trades in two different places, merchants will buy it cheap and sell it dear until the prices equalize. It's the foundational logic of globalism itself that a $9 disparity can exist and persist between the financial capitals of the East and West means the mechanism to correct it is broken. The arteries are clogged. The metal cannot or will not flow. And this failure is being broadcast during the period of greatest systemic vulnerability, the ghost week between Christmas and New Year. Trading pits are echo chambers, senior bankers are unreachable on ski slopes, and the markets are left in the custody of junior staff and, more importantly, unfeeling, unblinking algorithmic intelligence. These algorithms aren't sentient. They're sets of instructions. And their primary instruction is to identify and exploit pricing inefficiencies for risk-free profit. They see this $9 gap not as a crisis, but as the ultimate opportunity. Their code commands them, buy the cheaper asset. So they will. In the vacuum of liquidity that defines this week, their buy orders will hit a market with no opposing force. There are no deep pools of sellers, no market makers with ample inventory to absorb the surge. The result will be a price movement of pure, sterile physics, an object accelerating in a vacuum. The paper price of silver won't trend. It will gap, lurch, and possibly scream higher in a series of explosive jumps that technical analysis cannot predict and news anchors cannot explain. This is the immediate kinetic consequence, a volatility bomb primed by broken fundamentals and timed by the calendar. But to focus only on next week, S-explosion is to stare at the flash and miss the war. This pricing chasm is the most important financial signal of the decade because it is not the cause of the coming crisis. It is the first measurable symptom of a tripartite collision that has already been set in motion, a collision with a non-negotiable deadline, the year 2026. We are not looking at a market problem. We are looking at a systemic migration. The first force in this collision is regulatory. The Basel III and IV Accords, the global banking rulebook written after the 2008 crisis, are not mere guidelines. They are a financial constitution being imposed on the world's banks, with compliance cliffs that steepen through 2025. Their core innovation is a brutal reclassification of risk. Under these rules, the unallocated paper-based silver exposures that banks use to lubricate the global trading system, the futures, swaps, and ETF-backed derivatives, are being designated as capital-intensive liabilities. They are a drag on the balance sheet. Conversely, physical, allocated, vaulted metal is being treated as high-quality liquid collateral, a strength. The $9 gap is a live-fire demonstration to every bank chief risk officer that the paper market is becoming unhinged from the physical reality it is supposed to represent. Holding paper is no longer just a financial risk. It's a regulatory peril. The logical, inevitable institutional response is not to dabble more in paper, but to retreat from it and secure the physical asset that satisfies both the regulator and the new reality. When the planet's largest financial institutions begin a coordinated pivot from being liquidity providers in paper to desperate acquirers of physical metal, the demand on a market this small will be apocalyptic. The second converging force is geopolitical and industrial, a demand tsunami with the force of law. This isn't about speculative funds or investor sentiment. The $80 price in Shanghai is an industrial price, a survival price. It reflects the voracious, inelastic need of the green energy and technology supply chain. But this is merely the leading edge. The true wave is the trillions of dollars committed by Western governments via the Inflation Reduction Act and the CHIPS Act. Not stimulus packages, but national strategic commands. These laws mandate the onshoring of semiconductor fabrication, solar panel production, and electric vehicle battery capacity. They are not suggestions. They are blueprints for factories currently under construction. with completion and production targets legally pegged to 2025 and 2026. These facilities have bill of materials lists. At the top of those lists, for critical conductive pastes, contacts, and components, is silver. The offtake agreements, the contracts to secure thousands of tons of physical silver, are being negotiated right now in boardrooms you will never see. This is demand that does not consult a price chart. It is demand that says, we need this metal to turn on the lights in this billion-dollar factory, or the project fails and national security is compromised. When state-mandated industrial demand of this magnitude meets a supply chain already in deficit, the concept of a market price evaporates. It is replaced by the concept of strategic acquisition cost. The third force is the collapse of trust and the logistical run on the physical system itself. Every headline making withdrawal from a COMEX or LBMA vault, like the 1.4 million ounces that just disappeared from the registered category in a single day, is not a rotation of inventory. It is a permanent exit. That metal isn't moving to another trader's account within the same system. It's being loaded onto planes and ships, destined for refineries, and then into the bonded warehouses of Singapore, the vaults of Shanghai, or the strategic stockpiles of sovereign wealth funds. It is leaving the Western financial orbit, likely forever. This is a bank run, conducted in slow motion by nations and corporations, not individuals. Each geopolitical tremor, each price spike, accelerates the drain. Each drain makes the system more fragile, making the next price spike more violent. This is a positive feedback loop of depletion. By 2026, the logical endpoint of this trend is a Western paper market, the COMEX, the LBMA, that is utterly disconnected from the physical realm. It may still trade wildly, but it will trade as a pure derivative, a casino side bet whose price is irrelevant to anyone who actually needs the metal to build something in the real world. The real price, the one that matters for the energy transition and for national inventories, will be set in the East, in the physical markets where metal actually changes hands for immediate use. Therefore, the path is illuminated by this $9 flare. The volatility of the coming week is the first seismic tremor. The repeated tremors throughout 2024 and 2025 will be the sound of institutions repositioning, of supply chains snapping, of the regulatory vice tightening. And 2026 is the quake, the year when these slow-moving forces reach their synchronous crescendo, formalizing the bifurcation of the global monetary and commodity landscape. Your task in this moment is not to be a trader. It is to be an archaeologist of the future, understanding what this crumbling data tells us about the next epoch. If your wealth is tied to physical silver, you are no longer holding a speculative asset. You are holding a deployable, strategic resource in a world that is on the brink of aggressively reclassifying it as such. The paper price on your screen is becoming a phantom, a shadow cast by a dying system. The real value is the unyielding metallic weight in your possession, an asset that exists outside the digital ledger that is about to be forcibly rewritten by regulation, geopolitics, and raw necessity. This gap is the last clear signal before the noise of crisis drowns everything out. It is the final indication that the old rules of finance, built on paper promises, and efficient markets are being superseded by the older, harder rules of physics, scarcity, and power. The clock is not ticking down to an event, it is ticking down to a new reality. The $9 chasm is the doorway. Thanks for watching, and be sure to subscribe for more deep dives into the financial shifts that will define our future.